guys, welcome back to my channel. Don't forget to like, comment, share, and subscribe. New York. The US economy will need high monetary policy for some time before inflation is under control. A fact that means lower growth, a weaker job market, and some pain for household and business. Federal Reserve Chair Jerome Powell said on Friday in remarks, warning there is no quick cure for fast raising prices. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation. They will also bring some pain to households and business, Powell said in prepared remarks for a speech to the Jackson Hole Central Bank's conference in Wyoming. Sandra Holtworth, head of Red UK at Aegon Asset Management. In a short and concise speech, he made several points. Firstly, that the economy was still showing strong underlying momentum and that the labor market in particular remains out of balance. Second, that interest rates will continue to rise to a restrictive stance and importantly stay there for some time, partly because the Fed views it will take time for inflationary force to decline, but also because in previous inflationary episode it was a mistake to relax policy too early. In short, Powell's short but direct speech was focused and delivering a message to the market to reset expectations for a longer period of maintaining tighter monetary policy conditions in order to successfully combat inflation. He provided a historical context and justifications for the need to maintain levels once the current cycle peak is reached and indicated the Fed's willingness to do so even in the face of a recession and rising unemployment. So, the headline summary is that we are getting closer to the peak, but we will plateau for an extended period prior to any potential path downward. It was pretty much in line with what we're expecting, and that even though they don't want to give forward guidance, they are going to try and guide markets to the idea that they are going to slow down the pace of the hiking cycle, but they are going to offset that with the idea that rates are going to be restricted for longer, and that was what was stressed within the actual statement, that duration is not the preference. Having a longer period of tighter monetary policy is opposite to, continuing front-loading it at the expense of potentially having to cut rates in the future. I don't think markets necessarily praised this court to begin with. This was a speech for his legacy because this faith has been tarnished for its stubborn, which was exacerbated by a perception that Powell wouldn't be taught enough to do what necessarily to expel inflation from the economy by invoking the work of other chairmen who have had to deal with inflationary pressures. Powell made it clear how we want to be perceived as a weak chair who restored price stability in order to restore a strong economic foundations. Given the backdrop of easing financial conditions since early July, as we expected, we have seen a pushback by Fed Chair Jerome Powell on the market assessment of an immediate pivot by warning against loosening policy sooner rather than later. Whilst inflation has started to show signs of a turn, some of the more resilient and persistent components remain elevated. In addition, the labor market remains tight. The one sector which is showing signs of clear slowdown in activity is housing. In his speech, Chair Powell kept a rate raise of 75 BP on the table for September, We have now revised the terminal rate to around 4% from 3% previously, and think rates may remain higher for more, which seems more consistent with the Fed's stance of keeping policy restrictive until clearer signals of economic and inflation slowdown appear. Maybe that's all from me. Thanks for your attention. Thanks for the watching. Don't forget to like, comment, share, and subscribe.